Welcome to World Really Works. I'm Daniel Wright. In January 2026, gold futures in New York briefly traded above $5,600 per ounce. At the time, many investors expected prices to move higher. Some models projected $6,000 instead. Gold reversed sharply. This raised a familiar debate: did the gold bull market end or just a correction? But framing the issue this way misses the core mechanism. Gold does not behave like a typical asset. It does not primarily reflect growth, it does not price productivity, and it does not generate cash flow. Gold responds to confidence, specifically confidence in the monetary system. To understand this, we need to go back to how gold was priced in the first place. Before 1971, gold did not trade freely. The price was fixed at $35 per ounce, set by the U.S. government. Under the Bretton Woods system, the dollar was convertible into gold. This made gold part of the monetary architecture, not a speculative asset. That architecture relied on one condition: that the supply of dollars would remain consistent with gold reserves. Over time, that condition failed. During the 1960s, the United States expanded fiscal spending. Vietnam War expenditures increased. Domestic welfare programs expanded. Budget deficits widened. The supply of dollars grew rapidly. Gold reserves did not. In 1971, the U.S. suspended dollar convertibility into gold. This decision, often referred to as the Nixon Shock.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Effectively removed gold from the monetary system. From that point forward, gold no longer functioned as money. It began to function as something else, a measurement tool. Gold started reflecting stress within the fiat currency system. The first clear signal came in the 1970s. Two oil shocks disrupted global supply chains. U.S. inflation reached 14%. Real interest rates turned deeply negative. Equity markets stagnated for nearly a decade. In that environment, holding cash imposed a real cost. Gold prices rose accordingly. By 1980, gold reached $850 per ounce, an increase of approximately 24 times from its fixed price era. However, this period also illustrates gold's limitation. Once monetary credibility is restored, gold loses its function. In the early 1980s, Federal Reserve Chairman Paul Volcker raised interest rates to nearly 20%. Inflation expectations collapsed. Real yields turned positive. Capital shifted toward productive assets. Between 1982 and 2000, the Dow Jones Industrial Average rose from roughly 800 points to 11,700, including dividends. Total returns approached 18 times. During that same period, gold declined by nearly 70% and remained below its 1980 peak for over 2 decades. This illustrates a consistent pattern. Gold performs best when monetary confidence deteriorates. It underperforms when confidence is restored. The second gold bull market began around 2001, but under different conditions. This period coincided with the financialization of gold. The introduction of gold ETFs allowed institutional investors to allocate to gold at scale. Liquidity increased, volatility increased, correlation with macro variables strengthened. Between 2001 and 2011, gold rose from roughly $250 to $1,920 per ounce. The reversal came in 2013 when the Federal Reserve signaled a reduction in asset purchases. Gold declined by 28% in a single year. The rationale was structural. Liquidity conditions tightened. Systemic risk perceptions declined. Gold was no longer required. The current gold cycle, which began around 2019, differs in one critical way. Its initial driver was not private capital, it was central banks. Non-Western central banks, including China, Russia, and India, increased gold purchases substantially. This shift reflected diversification concerns, not speculative intent. For the first time, a gold bull market was driven from the top down. Gold prices rose from approximately $1,300 to $3,500 by mid-2025. At that point, central bank purchases slowed. The policy objective had largely been achieved. Subsequently, a different group entered the market: ETFs, private investors, momentum-driven capital. Gold's role shifted again from a strategic reserve asset to a price-sensitive trade. This transition increased fragility. Between late 2025 and early 2026, gold rose more than 20% in 2 weeks. Leverage increased. Positioning became crowded. Under these conditions, price stability depends on continued inflows. When that assumption breaks, reversals become abrupt. This brings us back to the recent decline. While near-term catalysts included monetary policy signals and technical factors, the underlying issue was structural. Gold prices had detached from their traditional anchors. The U.S. dollar did not experience a comparable decline. Long-term Treasury yields remained stable. Medium-term inflation expectations moved lower. This divergence indicates asset decoupling. Historically, sharp corrections do not necessarily end gold bull markets. What matters is whether the incentive structure changes. Gold is not a growth asset. It is a hedge against systemic malfunction. Therefore, the relevant question is not whether gold will rise further. The question is what risk investors are attempting to hedge. When gold remains quiet, the system is functioning. When gold accelerates rapidly, it suggests that confidence is eroding, often before the cause becomes visible. That is how the world really works.